Welcome to Trading Feeling Mind, where we decode the complex world of financial markets into simple, actionable strategies for your success. Imagine standing in the middle of a chaotic storm where numbers flash like lightning and fortunes are made or lost instantly. Many enter this arena treating it like a casino, throwing money at the screen, hoping for luck to save their account. The market is a mirror reflecting your deepest fears and greed, punishing those who let their raw emotions drive their decisions. We have all felt the stinging pain of a red portfolio, watching hard-earned savings vanish because we refuse to accept defeat. But there comes a moment when you must choose between continuing to gamble blindly or deciding to learn the professional craft. Trading is not about predicting the future with a crystal ball. It is about probability, risk management, and mastering your mind. Today, we embark on a comprehensive journey to transform your chaotic approach into a structured, disciplined, and profitable trading business model. Before looking at a single chart or indicator, we must first conquer the battlefield that exists within our own chaotic minds. The fear of missing out drives traders to buy at the top, exactly when the smart money is preparing to sell. After a loss, the urge to win it back immediately is strong, but revenge trading is the fastest way to bankruptcy. Professional traders are like snipers, waiting patiently in the shadows for hours or days for the perfect setup to finally appear. Discipline means following your rules, even when your emotions are screaming at you to do the exact opposite during a trade. You must accept that you cannot control the market's direction, but you can always control your entry, exit, and risk size. Keeping a detailed trading journal is the only way to track your emotional state and identify the recurring patterns in mistakes. Learn to detach your self-worth from your net worth, understanding that a losing trade does not make you a losing person. Success comes from a boring, repetitive routine of analysis and execution, not from the excitement of a high-stakes adrenaline rush. Once you master your internal psychology, the external charts become clear, logical maps rather than scary monsters trying to take money. Now let us look at the charts, which are simply the visual representation of human psychology fighting between buyers and sellers. Japanese candlesticks are the alphabet of this language, telling us the story of who won the battle during a specific time frame. A doji candle represents indecision in the market, a potential sign that the current trend is losing momentum and might reverse. An engulfing pattern shows a massive shift in power, where one side completely overwhelms the other, signaling a strong new direction. Support is a floor where price stops falling, representing a zone where buyers perceive value and step in to push up. Resistance is a ceiling where price struggles to break through, a zone where sellers are aggressive and supply exceeds the demand. Connecting the highs or lows creates a trend line, acting as a diagonal guide to help us trade in the right direction. Always remember that the trend is your friend until it bends, so never try to catch a falling knife in trading. A breakout occurs when price shatters a key level with high volume, indicating that a powerful new move is just starting. Be wary of fakeouts, where price briefly breaks a level to trap traders before snapping back in the opposite direction quickly. Understanding market structure, the sequence of higher highs and higher lows, is crucial for identifying the true direction of the flow. Analyzing multiple timeframes allows you to see the bigger picture while finding precise entry points on the smaller, faster charts. Indicators are mathematical tools that help us confirm what price action is telling us, acting as a compass in the storm. The moving average smooths out price data to show the underlying trend, acting as dynamic support or resistance for the price. When a short-term moving average crosses above a long-term one, it signals a golden opportunity that momentum is shifting to bullish. The relative strength index measures the speed of price changes, helping us identify when a market is overbought or potentially oversold. Divergence happens when price makes a new high, but the indicator does not, warning us that a reversal is coming soon. The MACD indicator reveals changes in the strength, direction, momentum, and duration of a trend, providing powerful signals for entry points. Bollinger Bands expand and contract based on market volatility, helping traders identify periods of calm before a massive, explosive price move. Volume is the fuel of the market. A price move without strong volume is like a car trying to drive without gas. Fibonacci retracements use nature's golden ratio to predict hidden levels of support and resistance where the price is likely to bounce. The secret sauce is confluence, which means finding a setup where price action, patterns, and indicators all align in perfect harmony. Do not clutter your charts with too many indicators. Paralysis by analysis is a real danger that prevents you from acting. Before risking real money, you must backtest your strategy on historical data to prove that it actually has a winning edge. Now we discuss the most important topic of all, risk management, the shield that protects you from the market's deadly arrows. Your primary job as a trader is not to make money, but to survive long enough to catch the big moves. A stop loss is your insurance policy. It is a predetermined exit point that prevents a small scratch from becoming fatal. Never enter a trade without a stop loss in place, because the market can move against you faster than you react. Position sizing determines how much you buy. Never risk more than 1 or 2% of your total capital per trade. Always look for a risk-to-reward ratio of at least 1 to 2, meaning you aim to make double what you risk. With a good risk-reward ratio, you can be wrong half the time and still be a very profitable trader over time. Leverage is a double-edged sword that can amplify your gains, but also wipe out your entire account if used without caution. Protect your emotional capital as well. If you are stressed or desperate, you will make mistakes that cost you real money. Consistency in risk management is the boring secret that separates the wealthy professional traders from the excited amateurs who eventually lose. Trading is a marathon, not a sprint. It requires years of dedication, study, and the resilience to bounce back from failure. The market is always evolving, and so must you. Commit to being a lifelong student of the economy and human psychology. Find your unique edge, the specific style of trading that fits your personality, whether it is scalping, day trading, or investing. Trust your analysis and your plan. When the moment comes, execute without hesitation and accept the outcome with a calm mind. You do not have to walk this path alone. Surround yourself with positive, like-minded traders who push you to be better. Imagine the freedom that comes with mastering this skill, the ability to generate income from anywhere in the world using only laptop. If you are ready to master the charts and your mind, subscribe to our channel and join our community of traders. Thank you for watching Trading Feeling Mind. Keep learning, stay disciplined, and we will see you in the next educational video.